Hello YouTube user, and welcome to this special video report on the upcoming hearing of the U.S. Senate Banking Committee. On May 16th, top executives of what were once two banking giants Silicon Valley Bank and Signature Bank will be testifying on the roles they played in their downfall. In March of this year, a shocking announcement spread across financial markets. The two banks, each of which held well over $2 billion in assets, suddenly collapsed in quick succession. Both banks were overseen by powerful federal regulators, who quickly launched a probe into the cause of the downfall. It was later learned that the collapse of the banks was due to poor oversight and an excessive amount of risky investments. The banking executives, particularly those at Silicon Valley Bank, were accused of ignoring responding to multiple warnings from federal regulators that interest rates were rising rapidly. This led to investments that were unable to withstand the rise of these rates, ultimately leading to their collapse. This controversy was amplified when four of the bank's top executives were revealed to have sold a combined total of $30 million of stock in the weeks and months before the banks went under. It was later discovered that these same executives had been paid their annual bonuses just hours before the federal government took over the banks. As a result of this scandal, the U.S. Senate Banking Committee has requested that both former Silicon Valley Bank CEO Greg Becker and former president and chairman of Signature Bank, Scott Shea and Eric Howell, to testify before the committee on May 16th. They will be joined by the chair of the National Credit Union Administration, Todd Harper, as well as top state regulators Clotilde Hewlett and Adrian Harris. It promises to be a tense hearing, and it will be the first time that these executives address the public about their roles in the downfall of both of these banks. But why was this collapse so important? Well, not only does it mean a huge loss for the thousands of customers of both banks, but it also raises many questions about the role of federal and state regulators in protecting customers from taking on too much risk. By putting these executives into the hot seat, senators hope that they'll gain a better understanding of what happened and create better regulations in the future to stop this type of situation from happening again. So stay tuned for more updates on the upcoming hearing of the U.S. Senate Banking Committee, and we'll keep you informed how this situation develops. Thanks for watching.